Welcome back to another video here at FiscalVoyage. My name is Felix. So in this video, I'm going to talk about my most recent purchase. This purchase is actually a new position for my portfolio, and I'm very happy with the valuation currently. First, if you're new to the channel, make sure to hit that subscribe button, and also make sure to check out my free ebook that I have in the description. There's a link to it. It's a free ebook with 5 quick metrics that I look for before I spend time and resource into evaluating a company. So this video, I'm going to talk about my new purchase in Intel shares. I actually made a video a few weeks ago about Intel and saying how the company was slightly undervalued and a hold. But because of the most recent drop in share price, I actually purchased shares of Intel and opened a new position. Make sure to check out that video I made on Intel, and there's a link here to it. So here's my transaction history of Intel. I bought 21 shares of Intel at $47.79 or 80 cents. That total came out to be $1,003.70. And I bought the shares on August 7th, 2020, so 3 days ago. On Friday I bought it. If we look at my previous video that I did on Intel on July 20, 2020, I did a stock analysis on Intel, and the comment is, the title is it a good price right now? And you go back to that video to see some of the other things I talked about, like revenue growth, net income growth, the balance sheet, things like that, the future outlook. As you can see here, I had the fair value estimates from the different analysts, and as well as mine, dividend discount model analysis. And you can see here, go fast in here, the fair price was $63.58 on this date, and on that day, the price, well, this was actually supposed to have been August, July, and then $60.20 was the current price for Intel. So the company was undervalued by 5.6% based on these fair value estimates. But even with that, I gave the company a hold recommendation because I thought the valuation, the company, was doing great. Earnings are expected to be higher, revenue growth, income growth looking good, but just the valuation I wasn't comfortable with. And because of that, now with the recent quarterly report earnings release, the shares dropped dramatically. So I made that video on 7/20, so around here. So a few days later, the price basically dropped all the way down to as low as $47.73. And as you saw, I bought shares at $47.80, which is, wasn't at the bottom, but no one could really get the bottom. But anyway, so right now it's up 1.17% as of today. But if we look at our fair value estimates, some things have changed, but not dramatically. First, the reason for the drop was because of the product delay offset strong earnings, lifting competitor AMD. In the quarterly release, Intel says to expect the 7nm products in late 2022 to early 2023. So they found a defect mode in the process, and they invested in contingency plans, including an external third party. So this news dropped Intel shares at this date by 8.7%, actually dropped further than that, almost 10% I think it was. And AMD, as you see here, gained 6%. It was actually a little higher when in the preceding days. But overall, Intel quarterly report was very good actually. As you can see here, Intel quarterly report, here it is, second quarter 2020 financial results. You can see here revenue was up 20% versus second quarter 2019. Operating income up 23%, net income up 22% on the GAAP, and non-GAAP up 10%. So earnings was up almost 30%, non-GAAP up 16%. So the quarter was very good actually. Just the reason why the price dropped dramatically was because of that news of the processor delay. So if we look at the fast graph here, you can see here, this is when the price dropped. It basically dropped almost 20% really, from 630 which was $59 or about $60 to where it is on Friday. This was Friday close at $48.03. So the price dropped almost 20%. And because of this drop, I saw as opportunity, as you saw, because based on analysts, which they actually do a pretty good job in doing earnings estimates, because the company beats it most of 64% of the time, or they hit it 27% of the time. So I could trust these numbers very confidently. And as you can see here, if I look from Friday's closing price to a PE of 13 based on 2022 earnings of $5.19, we have a pretty good rate of return of 17.5% annually. So that's great. In 3 years, having almost a 20% annual rate of return is very good. And the company has a blended adjusted earning yield of 10.11. Would you like to see it at 6.5 or higher? So this is real good here. They have a nice dividend yield of 2.75% because of the drop. The drop lowered the dividend. So that's great. And again, if you look at the previous video, they have a great balance sheet. I go more in detail on that in that previous video, but as you can see here, they have a credit rating of A+, and only a 29% long-term debt to capital ratio, which is 29%. So that's real good. And if we look at the long-term 3 to 5 year growth, you can see here with a PE of only 10, you could average total annual rate of return of about 11%, which is still real good. But if the company goes back to a normal PE around 12 or even 13, as you can see here, you could potentially get 20% of annual rate of return. And here's this little trick that I like to use with FastGraph, because you can see here the company tends to be around, when it's undervalued, around 11 or 10. So if we use 11 PE and apply this, you can see the times when the company was undervalued or close to it. So anything really under 11 is a buy based on this little trick that I like to use. As you can see here, these are opportunities when they had a PE of 9, a PE up here is 10.6. Over here, it had a PE of 10.9. So these were buying opportunities, and guess what we got here? A PE of 9.89. So let's get this closer here. 9.89. So if history is correct here, we expect a nice growth or return from this point on. So let's look at the fair value prices for Intel. Some of them changed, some of them haven't. For example, CFRA changed, it dropped it a little bit. Morningstar stayed the same. FastGraph at 62 was the same. Yahoo dropped a little bit at 56. And my dividend discount model analysis, I did something a little different. I think it's more correct now than when it was before. I used a 6% dividend growth for the next 3 years and 6% after that with a discount rate of 9%. That's how we get $46.64. And as you can see here, the fair price averaging out to 5 gives us $63.12. And currently the company goes for $48.59. So that means it's undervalued by 29.9%. So almost 30% undervaluation versus the 5%, I think it was, undervaluation from my previous video. This is why it's so important to find a fair value and give yourself a margin of safety. Even though Intel was quote unquote undervalued in my last video, I still gave it a hold because of the margin of safety. I didn't feel comfortable with just a 5% undervaluation, and the earnings growth is not 15%, 20%, 25% every year. Then if it was at 20% or more earnings growth and a 5% undervaluation, then I would have said it was definitely a buy. But because earnings growth is around 6 or 7%, and the undervaluation wasn't too low, that's why I had it as a hold. But right now, at a 30% undervaluation, I give Intel as a buy, and as you just saw, I bought shares personally of this company, and that actually was my first initial shares purchase. And I do plan on buying more shares if it continues staying at this level. So there you have it. I purchased Intel shares because of the price drop. In my previous video, the company was doing great. And actually the earnings report was great. As you saw, 20% revenue growth, net income growth, earnings growth, all that. The only reason why it dropped was because of that processor delay, which is understandable because it may affect the future earnings and revenues. I see it as one of those, unfortunate news, but it's not something that's gonna damage the company, long term. So thank you for watching, and if you enjoyed the video, make sure to hit that like button and subscribe if you're new to the channel. And also, don't forget to check out my free ebook, 5 quick steps or quick metrics to look for before spending time and valuing a company. So I'll see you guys in the next one.